Welcome to the Bull Strangle strategy. Our approach combines stock ownership with systematic option selling to generate income while maintaining long-term market exposure. Every trade follows a repeatable process built around stock selection, premium collection, risk management, and disciplined execution. Let's get started. When selling options, most traders naturally focus on implied volatility because higher implied volatility generally means larger option premiums. But during my research, I found that the premium himself wasn't the whole story. One of the strongest predictors of consistent performance was the relationship between implied volatility and historical volatility, or IV by HV. Let's look at why this simple comparison became an important part of my stock selection process. So what are IV and HV? Historical volatility measures how much a stock has actually moved over a recent period. Implied volatility measures how much movement the options market expects going forward. One looks backward, the other looks forward. By comparing the two, we gain insight into whether option premiums appear inexpensive, fairly priced, or potentially expensive. Why this matters. When implied volatility is substantially higher than historical volatility, option buyers are paying for future uncertainty that may never materialize. For option sellers, those situations often provide the opportunity to collect richer premiums without necessarily accepting proportionately greater risk. Of course, nothing is guaranteed. Sometimes future volatility expands exactly as the market expects, but over many trades, this relationship proved surprisingly informative. After analyzing thousands of trades in the database, a consistent pattern emerged. Higher IV divided by HV ratios generally produced higher average returns, better win rates, fewer large losses, and more consistent overall performance. But no single indicator predicts success, but IV and HV repeatedly separated stronger candidates from weaker ones. So why does this work? The explanation is fairly straightforward. Option buyers pay for uncertainty. When implied volatility rises much faster than the stock's actual volatility, option premiums can become overpriced relative to recent price behavior. That pricing imbalance creates a statistical edge for disciplined option sellers. Like every factor in the Bull Strangle ranking system, IV by HV isn't used by itself. It's combined with institutional ownership, stock price, the price divided by ATR, or the average true range, short interest, and trend. Each metric contributes a small independent advantage. Together, they improve the probability of selecting stocks that are better suited for consistent option income. So far, we've examined institutional ownership, price divided by average true range, and IV divided by HV. Next, we'll explore another important ranking factor, which is short interest, and discuss how market positioning can influence option selling opportunity. One last thing to share was an unexpected discovery that occurred while doing this research. What has surprised me most about the relationship showed up even before considering option premium. My research tracked only the movement of the underlying stock, yet stocks with higher IV by HV ratios consistently produced better stock performance for the Bull Strangle strategy. That suggests that this relationship isn't simply identifying richer premiums, it's also identifying stocks where the options market is overestimating future risk. That's a much more compelling finding because it isn't dependent on option pricing. Before you go, continue your Bull Strangle journey. Visit bullstrangle.com to receive weekly stock selections, option selling opportunities, and ongoing research designed to help investors generate consistent income. For a complete step-by-step guide, pick up a copy of the Bull Strangle strategy, which is available on Amazon. Research, discipline, consistency, income. Thanks for watching, and we'll see you next time.